Hi, in this video we are going to see about the fundamental analysis. So what do you mean by the stock analysis? Before going into the part of the fundamental analysis, why we need to do the stock analysis? So the first and foremost thing when you want to do the stock analysis is you have to go step by step and find out whether is it worthwhile to invest in the particular stock or not. So you can classify the stock analysis into two approaches. One is fundamental analysis and then the other one is technical analysis. In this video we are going to see about the fundamental analysis. In the case of fundamental analysis, we need to study about the financial background of the company. So here we have to consider the three factors: economic factor, industry factors and company factors for doing this fundamental analysis, and it covers the broader area of the economy as well. So in the case of technical analysis is mainly done based upon the stock price movements. Okay, so it purely depends upon the stock prices as well as the volume of stocks that are being traded in the stock exchanges. So what do you mean by this fundamental analysis is, okay, so it provides you the holistic approach to study about the business. If you take in the case of a market participant, the market participant needs to decide on the objective, whether it is going for a long-term investment or else for a short-term investment. If a market participant is going for a long-term investment, obviously he needs to study about the business performance, whether the company is doing well or not. So how to measure whether the company is doing well or not can be done with the help of this fundamental analysis. So it is very critical for an investor to eliminate the daily short-term noises which happens in the movement of the stock prices. So we have to eliminate these noises in the stock prices and then we have to go in for analyzing the financial statement of the company. So over a long period of time, a company which is very strong in terms of financials will be performing very well, so that it is possible for the market participant to create a wealth. And if you take in the case of companies in India which are being listed in the stock exchanges like Infosys, TCS, HDFC Bank, HR Motors, Bosch India, Nestle India, which is all like blue chip companies, year on year they are capable of giving a 20% CAGR. So what do you mean by the CAGR? How it is going to influence or else affect the investor is, if the company is having a higher CAGR, which means like they will be getting more money or else more return. So all these companies which I have listed here is capable of giving double, or else it is capable of double the money, or else it is capable of providing you a higher return. So higher the CAGR, faster is a wealth creation. Some companies like Bosch India Limited have delivered nearly 30% CAGR. So the magnitude and the speed at which wealth is created is one of the prime most concept that needs to be considered when you are looking for the fundamentals of strong companies, financially strong companies. So in this chart, here I have displayed the stock prices of chart of Tata Motors right from 2004 to 2024. If you see in this chart, from 2004 to 2015, okay, so nearly 9 years, the movement in the stock prices are very minimal, whereas beyond 2015 till 2024 you can see like there is a drastic increase in the stock prices of Tata Motors. So what we have to do between 2004 to 2015 and 2015 to 2024 is, there is only a marginal spike in stock prices. So there is only a small, the investor or else the trader will be getting a marginal return. So if these stock prices is the increase in prices are very minimal, means it is better to go in for short-term trading instead of going for a long-term investment. And if you see from 2015 to 2024, you can see like there is a sharper increase in share prices, which indicates like the company is financially stable as well as it is performing very well. What is the objective of this fundamental analysis? Why we have to do the fundamental analysis is, with the help of this fundamental analysis, we can identify whether the company is making money or else losing it out, and whether the company is managing their debts well or else whether it is drowning the company, and whether the people are buying their product or services, and how does it compare to other companies in the same industry. All these things can be done with the help of this fundamental analysis. And what is the importance of this fundamental analysis is, it helps the investors to determine the intrinsic value of the stock by thoroughly analyzing the company's financial wealth. Whereas if you take in the case of technical analysis, we are not going to find out the intrinsic value, we are just going to find out the stock price movements alone. Whereas here you can find out the intrinsic value. And if we found out like if the stock has been mispriced, stocks means that can be studied or else that can be rewritten in the case of this, or else you can just identify which stocks are being mispriced. And it also allows you to select the undervalued stocks which are likely to outperform over time. If you take in the case of Tata Motors, which I have cited before, between 2005 to 2014, you can see like only there is a marginal increase in stock prices. So that is all like undervalued stocks. But if you see in the case of 2024, in the year 2024, same Tata Motors have produced a return of nearly like 100%. And next one is, it helps to deduct overvalued stocks which has a downside risk as well. And fundamental analysis also helps to provide a warning signs like unsustainable growth, excessive debt. If there is any management turmoil which is going on the organization, can also be identified with the help of this fundamental analysis. As well as it also helps to avoid overpricing stocks, thereby we can prevent the losses. From where do we get all these data? Okay, in the case of fundamental analysis, the main thing is we are going to take data from the company annual reports. Okay, so in the case of company annual reports as well as the company financial statements, okay, and industry data and macroeconomic indicators, all these will be providing you the data source for doing this fundamental analysis. In fundamental analysis, there are two approaches. One is either top to bottom approach or else bottom to top approach. In the case of top to bottom approach, okay, we can do like company analysis and then go in for industry analysis or else economy analysis. Whereas in the case of bottom down approach, it is reverse order, where you have to do economy analysis, industry analysis and company analysis. Okay, so it varies from analyst. Okay, so when you take in the case of economy approach, these factors has to be considered, like GDP of a country and what is a foreign policy that has been prevailing in the country at present, and inflation rate, and what is the climatic conditions of the particular country, and what is the debt overall debt situation, interest rates and even unemployment rate. All these things has to be considered before investing or is going in for this fundamental analysis. And then moving on to the industry analysis, we have like different stages in industries, okay, like emerging stage, growth stage, maturity stage and declining stage. And this industry analysis can be done with the help of this Porter's 5 force model, where you have to thoroughly study about your competitor as well. And in the case of management or the company analysis, identify what are the product and services they provide, and who are the board of directors, managing directors, and what is the business model and framework they follow, and what is the composition of the capital they have, and market share, what is the management decisions and ratio analysis, strategies, are they going in for any new launch of product and services can also be done. So here we take an example how to do this macro level analysis, which is an economic analysis. Here we have taken an example of a Shoppers Stop. As we all know, like Shoppers Stop is a very renowned retail outlet which sells branded apparels, electronic items as well as lifestyle product. And how does this retail industry affect the GDP growth rate? So there is like the contribution of the retail industry, how far the retail industry is contributing to the GDP. I think nearly 12% of the GDP comes from the retail industries. Okay, so we have to study what is the GDP growth rate in the country as well as the unemployment level as well as the per capita income. Because if the unemployment rate is higher, obviously the consumer spending will be lesser. Okay, so GDP growth rate, unemployment rate and inflation rate has to be studied before going in for this fundamental analysis. And then coming to the part of industry analysis, we have to do a competitor analysis. If you take in the case of a Shoppers Stop, okay, which has brick and mortar retail outlets, which has so many brick and mortar retail outlets, and what is the threat to this brick and mortar retail outlet is the e-commerce sites. Okay, so they have to compete with the e-commerce site as well as the local retail stores. What is the strategy they have framed to overcome this e-commerce sites as well as the local retail stores has to be analyzed. And what are the other factors that can also be included in this industrial analysis is retail real estate sector, okay, which helps to determine whether the store can go in for the expansion plans across the country or else its warehousing platform. Okay, so we have to also consider the real estate situation when we are going in for this industry analysis, and we have to do the Porter's 5 force model in the industry analysis. And coming to the part of the company level projection, how far the analyst will be able to predict the market share and sales from the same store as well as the new stores added. And for this we have to take the financial statement of the company for the past 3 years or else 5 years, and we have to project it and find it out whether the company is performing well or not. And in the case of a sector and industry analysis, earlier we have seen in the EIC approaches. So industry approach, under industry approach we have like 5 stages in the industry analysis. Okay, first one is you have to identify whether the industry is in the emerging market. Okay, so in the case of emerging market, which leads to the birth of a new industry, when does the new industry will be coming out is when there is a disruptive innovation that has happened in the market, a new industry will be emerging. Okay, so there is a lot of uncertainty but also a rapid growth potential in the case of the birth of a new industry, and the company has to focus on product development, taking strategic positions in the nascent market. And next to the part of the emerging market, it is a growth stage. In the case of growth stage, the industry will be expanding their products, okay, their products as well as services which is being accepted by the customers as well as the consumers. And competition will start beginning in this growth stage, and which attracts more number of new entrants into the market, and companies invest in a larger scale and capacity to serve booming demand. Next stage is the shakeout stage in the industry analysis. Here the company starts to grow in this lesser pace, and there is an intense competition which can lead to weaker player to exit, and only strong competitors will stay in the market. And in the case of a maturity stage, there are stable competitors and the industry will be performing or is giving out a steady profit, and companies can optimize their operations while seeking small advantages through by means of product segmentation and market differentiation. And last stage in the industry analysis is obviously the decline stage. Here, if the industry is not having any innovations, okay, which will lead to manufacturing, which or else they will be producing only an outdated product. Okay, so if the innovation is not there in the industry, the industry will be in the declining stage, okay, and where the and it will also lead to revenue deteriorations will happens in this declining stage, and most of the companies eventually exit in the shrinking industries. And coming to the part of the company analysis, we have to understand the company performance and check the company's financial performance, analyze financial ratios, determine the fair value. And in the case of a company analysis, we have to study about the performance of the company by means of reading the financial statements like balance sheet and income statement and profit and loss account, and all the ratio analysis has to be done to find out whether the company is having debt or not, okay, and price earning ratios. And if you found out like the intrinsic value, you have to compare the intrinsic value with the market price and make a decision on whether to buy the stock or not. Thank you.